Welcome to another week of our Forex Trading School. And in this week, we're going to be looking at three concepts: liquidity, volatility, and stop hunt. For you to navigate the Forex markets, you need to understand these three concepts. Very, very important. And in the next videos, we are trying to round off this Forex Trading School so that we can start mentorship sessions. So we are going to be looking at order block, that is the concept of demand and supply in Forex market, right? And for us to properly understand order block, we're going to be looking at block trade. Okay, so after we have looked at order block, the next thing we are going to be looking at is fundamental analysis, and then lastly, we are going to be looking at correlation of pairs. Very, very important. I couldn't skip any of these because they are important. Then the ones that we're not able to touch very well in the mentorship classes or sections, we are going to take care of them. So quickly, let's delve into these videos. Please do not miss these last videos that we are going to be posting, right? Don't miss them. They are very, very important. So the first thing here is liquidity. What is liquidity in the Forex market? Liquidity describes the extent to which an asset can be bought and sold quickly and at a stable price and be converted to cash. Have you ever imagined why is it that the moment you place a buy order in the Forex market, it is being executed quickly, and immediately you place your sell order, it is being executed immediately? Who is at the receiving end? Why is it that anytime you are selling, there is someone buying, and anytime you want to buy, there is someone willing to sell to you? Have you ever imagined what happens behind the scene? That is what we are trying to understand in this class. Forex is considered the most liquid market in the world due to the high volume and frequency with which it is traded. And the concept of liquidity is so important because it impacts how quickly you can open or close your positions. If you place a sell order and there is nobody that is willing to buy at a time, that means that what you may end up selling at a very low price. But we have the privilege of the moment we click on sell is executed, the moment we click on buy is executed. Okay, let me explain this to you. Before now, this is the way people trade Forex. When you place your buy or sell order, you will need to wait. You will need to bear what we call a waiting cost. You will wait until you find someone who is willing to buy from you or sell to you. That is the way Forex has been for a long time. Later, some institutions said, let's solve the problem of waiting when people place buy or sell order. These institutions are called liquidity providers. What do? They provide liquidity so that the moment you click on sell, your sell will be executed. When you click on buy, your buy will be executed. For retailers like us, our liquidity providers are our brokers. Instead of you to wait, when you click on your sell or buy execution button, they will readily kind of buy it from you or sell to you with already available liquidity in the market. So when they give you this, you pay them what we call transactional costs. So they now bear the waiting cost for you until they find someone who is ready to buy or sell at the appropriate time. But what your broker does for you as a liquidity provider is to provide orders so that you will not need to wait when you want to sell. So when you want to sell, the liquidity they provided will take care of yourself. You take your money immediately. And when you want to buy, they provide others for you, liquidity, such that what you buy immediately. So you pay them transactional costs so that they can do the waiting for you until they find a buyer or a seller. So this is why the forex market is known as the most liquid market in the world. Why? Because there are liquidity providers that helps you to process your transactions immediately you want to sell or immediately you want to buy. So when we need to wait to execute order, we say that what the market is illiquid. But when we execute trade and convert our money immediately to cash, we say that what there is liquidity in the market. I don't know if this is clear. It should. Now, this transactional cost you pay is what we call spread. In the beginning of this forex trading school, I taught you spread. Spread is the transactional costs you pay your broker because your broker provided liquidity for you so that your transactions can be executed immediately. There is high liquidity in the market when there is what significant level of activities, trading activities in the market. And then we say that we have low liquidity if there are only a few market participants trading infrequently. If you are trading in Nigeria and you notice that what during New York session, London session in the morning and New York session in the afternoon, we tend to have a very high activity in the forex market. But immediately it gets to 6 p.m., 5 p.m., 7 p.m. in the evening, 8 p.m., the activity in the market starts going down. We say that what are those times where we have very little participants in the forex market, we say that what that is a time of low liquidity. In a liquid market, your spread will tighten, but you will notice that during odd hours of trading, that is when we have an illiquid market, that the legs of your spread will be very wide. But during New York session, London session, you notice that what that the spread of your pair that you are trading is very tight. You are paying very little transactional fee to your broker. But when you trade in odd hours, you will be paying so much. So a liquid market is safer to trade than an illiquid market. So if you're a day trader, this should be your business. Trade when there is a high level of activity in the forex market. That is London session and New York session. So we have been able to establish what liquidity is and who are liquidity providers. Our brokers, they are our liquidity providers. Now, the most popular traded pairs are the most liquid pairs. You don't just come and say, because I like a particular pair, that is what I will trade. You will consider the liquidity of that pair. You will imagine, why is it that people are trading Euro USD, USD JPY, GBP USD, USD CHF, USD CAD, AUD USD, NZD USD, gold, and the rest. It's as if there are these particular pairs that people trade. It is because of liquidity. You don't want to get into trading pairs that when you place your trade, you pay a high cost of spread, and also there will not be much activities in the market. So liquidity matters in forex because it tends to reduce the risk of slippage. It gives what faster execution of orders and tighter bid offer spread, or what we call spread. Let's move over to what is volatility in the forex market. The term volatility is the rate at which the price of a pair increases or decreases over a particular period. You will notice that some pairs in a day, they might just give you 10 pips. Some will give you 50 pips. Some in a day will give you 100 pips. Pairs like gold sometimes can go 800 to 1,000 pips in a day. It happens. So that is volatility. We say that gold is a highly volatile pair. That is why a lot of people, they don't trade it. Or Bitcoin. Bitcoin is even more volatile than gold. Okay. So some persons, they do not trade it because of what? High volatility. So the rates at which the price of a particular pair increases or decreases over a period of time is what we call volatility. So if you want to choose a pair to trade, you'll be looking at investing in highly liquid pairs and not too volatile pairs. Highly liquid pairs and not too volatile pairs. Also, you need to keep an eye on the factors that affect liquidity and volatility. I'm going to talk about some factors that affect liquidity and volatility. Now, let's start with liquidity. Number one factor that can cause liquidity in the forex market is expansion in a monetary policy. Expansion in a monetary policy. Whenever there are changes in the monetary policy of any country, it will affect the liquidity of the currency of that country. For instance, if there is a monetary policy that the government implemented that increased money flow in a country, what happens is that this will increase the income of people, and this will also do what? Increase their demand, because people tend to spend more when they have more money in their hand. So if a monetary policy pushes in more money in the hand of citizens, it will cause liquidity in the market because traders will have money that they will put in, thereby we have more participants in the forex market. The second thing that can affect liquidity is increase in global credit supply. If government increases loans, the borrowing rates in the country, it will affect the forex market liquidity positively, because a higher credit supply will lead to more money in the hands of traders and investors, who then invest the money in the forex market by buying currency pairs, thereby increasing liquidity. Anything that will make money be in the hand of traders and increase their probability of investing it into the financial markets, that thing has a tendency to affect the liquidity of that market, positively or negatively. And then the last but not the least is decrease in global credit demand. So when there is a decrease in global credit demand, the first one we talked about is global credit supply, whereby government is making more money available or more loans available to the citizens. Now, in this case, when there is a decrease in global credit demand, whereby people already have enough money to invest and trade, so automatically it means that they have enough money to invest. But if we have increase in credit demand, suggests that what? There is no money in the hand of traders, so they are looking for money. Everybody is looking out for money. That means what? There are no cash to be put into the financial market that can increase the liquidity of the market. So what of volatility? What are the things that can affect or cause volatility in the forex market? Number one is interest rate change. Any change in the interest rates affects the forex market volatility. An increase in interest rates in an economy will mean that what? Investors are going to cut back on their spending. Hence, the domestic currency price would substantially drop, causing high volatility in the forex markets. Similarly, if there is a fall in the interest rates, it would enable the people to spend more, as they will have more money in their hand. This will lead to what? A high market volatility due to the price fluctuations. And then the second thing that can affect volatility, remember, the volatility is the rate at which the price of an asset can increase or decrease over a period of time. So the second thing that can affect volatility in the forex market is economic shocks that affect supply and demand. For instance, when there is a taxation policy or a sudden change in the price of oil, This will affect the forex volatility. If the cost of living of citizens are affected negatively, they will not have resources for investment in the financial markets. This will reduce activity in the forex markets. So another thing is global changes and events. There are a lot of global changes and events that can affect the volatility of the market. For instance, the upcoming US election. The moment the US election is drawing close, most investors will stop investing in US currencies or things that affect US because of what they believe that what change of government means change in the political sentiment. You don't know what the new government is going to come up with. So when they come up with those policies and you've already invested, it can affect you positively or negatively. So this will definitely affect the volatility of the market because it is the participant that determines the activities or the rates at which price fluctuates in the markets. So what is the summary of liquidity and volatility? Liquidity and volatility are directly related. Low liquidity will lead to high volatility. High liquidity will lead to what? Low volatility. And when there is low volatility, currency do not fluctuate. We'll have a stable price movement and risk-free investment opportunity. But when we have low volatility, that is, prices of assets will be changing rapidly. When we have such, we have a risky environment for investment, making price unstable. You have seen how price moves during news, fundamentals, right? That is what high volatility. It is not safe to trade a highly volatile market, all right? It is better to trade a low volatile market with high liquidity. Now, the last but not the least is stop hunt. By stop hunt, we simply mean stop loss hunting. You know who a hunter is. A hunter is anyone who is there in the bush looking for a meat to catch. So, what does it mean when your stop loss has been hunted? And who hunts your stop loss? Stop loss hunting is a strategy to force others in the market out of their positions by triggering their what? Stop loss orders. You know where people place their stop losses and then price is moved in that direction. We normally experience this mostly during news, fundamental analysis or news trading. When there is a news release, we notice that what price will intentionally go and hit your stop loss, and then after hitting your stop loss, it will still go in your direction. That is what we call stop hunting. It is an intentional act that is done by big institutions. Now, they do it by what? They drive price of security up or down to where a significant number of traders, in this case, retailers, are expected to have set their stop loss order. Let me show you from this chart. Look at this zone. Let's just use this random zone to demonstrate this. Anyone who entered this buy here will have their SL here, right? Because these people, they understand that we work by what? Higher high, higher low, higher high, higher low. And then we have a universal teaching of where to place stop losses. So they know that all the people that bought here, their stop loss will be under here. So they will drive price down, clear all the stop losses that are here, and then still move in your direction. That is what stop loss hunting, okay? Do you know what happens when they trigger these stop losses? They will create a lot of volatility in the market. All the times that we have news release, we have a very high volatility in the market, which will definitely haunt the stop losses of retailers. Number two is that what? This will present an opportunity for investors who want to trade in this environment. So what is the wisdom? Whenever you are expecting a highly volatile market on news, wait for them to hunt stop losses. Don't be the stop loss that will be hunted. Don't be the prey. Always wait. And then when you now notice that they have come into the market, you join the big institutions to ride. We're going to explain this better when we get to fundamental analysis and other blocks. So you will understand this better. I'm just going to mention it and leave it this way. Stop hunting is that situation whereby the big institutions target to place their orders below where the stop losses of most retailers are. And when they do this, they are trying to drive up volatility in the market so that they can have a better opportunity, a better discount. So for you as a retailer, you have to position yourself with the mindset that what I don't want to be hunted, so you wait for these institutions to finish their hunting and then you join them after that. This will be it for liquidity, volatility, and stop hunt. In our next class, we are going to be looking at order block, but for us to understand order block, we must understand block trade. See you in the next video.